So the market hasn't been looking too well so far, with inflation at all-time high, interest rates are rising faster than our salary can catch up, and everything is getting so damn expensive. And if you're in the stock market, things don't look too good for us either. But then in all this chaos, there is a small silver lining here.
Well, there's a silver lining.
And in these times of high interest rates, there are some investment instruments that can provide some income in the short term while we wait for the market to show positive sign of the market turning. And the instrument in question today is bonds, but specifically Singapore Savings Bonds or SSB. And yes, I know that we've talked about SSB in a previous video, but within the realm of SGS or Singapore Government Securities, there is also another instrument called T-bills, which can provide some form of income as well. So for the uninducted, SSB or Singapore Savings Bond is a bond backed by the Singapore government, and in recent times the interest rate or the coupon rate of these bonds has been increasing, with the last one being at 3.21%, which is insanely high. And to put it into perspective, if you purchase $10,000 worth of bonds today, this will mean that you'll roughly get $300+ a year, which is paid out biannually, or roughly $150 every 6 months. And let's say if you do hold on to these bonds until maturity, this will give you a total yield of $3,213, which is pretty insane for passive income. So regardless of the market going up or going down, Singapore Savings Bond will continue to pay the agreed interest, and since it is backed by the Singapore government, it is pretty much super safe with almost 0% risk.
Risk? What risk?
But in recent times, I've been looking at T-bills, which is another Singapore Government Securities or SGS. So T-bills actually works a little bit different from SSB. So T-bills or Treasury Bills are short-term Singapore Government Securities which are issued at a discount to their face value. So most T-bills pays a fixed interest rate with a maturity period of 6 months to a year, and most of them are in 6 months tranches, which in investment terms is considered really short.
Really? How short?
So we know with SSB, with every purchase of $10,000, we get $300 a year or $150 every 6 months, and this is what we call a coupon rate. So T-bills works a little bit different. So let's say we purchase $10,000 worth of T-bills with a 3% discount on a 6 months maturity. What we'll be paying for is not $10,000, but $10,000 minus 3%, which brings us to a total of $9,850 because 3% discount is for a year. But our maturity period is only 6 months, so in actual fact, we are getting like 1.5% for 6 months, which is $150. So now, what we are doing is we are only paying $9,850 upfront, but at the end of 6 months, we will receive back $10,000, which is super amazing. So T-bills are released twice every month as compared to SSB, which is released once a month. So if you are looking for some short-term stuff, this could be something for you to consider. But now you must be wondering what are the differences between SSB and T-bills, because they seem very similar in nature. So there are 3 main differences here, which I think are the most important, but there are other differences which I think is like, it's almost negligible. So the first difference here is the most obvious one, which is the investment period. So SSB has a 10-year maturity period, which is considered long as compared to T-bills, which is only 6 months to a year, which is considered short. And having said that, but do remember that SSB, you can redeem them early if you want, and if you redeem your SSB early, you'll receive your capital plus whatever accrual interest that is paid back to you. So T-bills on the other hand are a little bit less liquid, and by getting T-bills, your funds will be locked in for 6 to 12 months, depending on the tenure that you select. So if you're going for T-bills, make sure that you don't need to touch this sum of money for the next 6 months. So now we know how T-bills and SSB work. One of the biggest difference is knowing how much you'll receive. So for SSB, MAS or the Monetary Authority of Singapore will announce the interest rates at the beginning of every single month, and this allows you, the investors, to decide for yourself if you're interested to get this month's SSB or wait for the following month's SSB. So if the interest rate doesn't look too good, like in June 2020, the SSB was below 1%, and now in October 2022, the interest rate is at 3.21%, so this gives you an option to decide whether you should go for SSB now or you should just ignore it totally. So T-bills on the other hand, they run on an auction basis, so we're not able to see the discount rate until it's closed. So this put a question mark to what the discount rate could be at the end of the day. But as investors, we want to have as high of a discount as possible, so we pay less for more money. So for example, for the T-bill that just closed in October, you can check out the yield on MAS website and you'll see 3 different yields. So there's a cutoff yield which is 3.77%, the median yield of 3.35%, and the yield average of 3.07%. So to make it easy to understand, there are two types of bid that you can go for if you are going for T-bills. The first one is a non-competitive bid, and the second one is the competitive bid. So in a non-competitive bid, the investor, in this case it will be you, will be able to choose how much you want to invest, but you cannot see your yield rate. And this will probably be easier for beginners like me and you who are not bond or treasury bill experts. So one of the benefits of non-competitive bids is that we get allocation first up to the first 40% of the total issuance. And the second benefit here is that we will get a cutoff yield which is the highest accepted yield of the successful competitive bids. So if you're not an expert, non-competitive bid is something you should go for. Competitive bidding will allow you to choose the yield that you wish to receive, and you will only get accepted if the yield exceeds your indicated yield. And by doing so, do note that you might not get the full amount that you've applied for because it does depend on your bid compared to the cutoff yield. So the most crucial differences here between T-bills and SSB is the minimum investment required for these two instruments. So SSB allows you to start investing with as little as $500 and in multiples of $500, while T-bills starts at $1,000 and every multiple of $1,000. Though both these yields might be very similar, investing is also about cash flow, because if you overinvest in a certain month, this might make things very uncomfortable for the following month and might throw you off your investment plans. So at this point of time, you must be wondering, which one should I pick? So at this current time, both of these are great investments, and having the option to lock in for 3.21% for October's SSB can be a great option to continuously get some income for the next 10 years. And if you're just starting out, SSB will be something you might want to look into because of the low barrier of entry and a secure stream of income for the next 10 years as well. But if you have additional cash after investing in SSB, T-bills could be something you want to look into to give you additional income. But if you're investing in T-bills, do note that your funds will be locked for the next 6 months and you must not need this money. So I hope this video has given you some insights between picking T-bills and SSB, and if it did, do drop a like to support the channel, subscribe, turn on the notifications if you haven't, and as always, stay safe, invest safe, and I'll see you in the next one.